Hi, Dominique, and welcome to another edition of The Week Ahead. How are you doing?
Fine, thank you, Andrew. It's good to see
Okay.
you. I miss the palm trees swaying.
Next week,
Okay.
they'll be back. Um, let's dive right in. And obviously, there's been a lot of action in kind of, I guess, U.S. fixed income. A lot of questions around the movements we've seen. Obviously, there was a bunch of interesting data that came out this week. Less about particularly around the Fed. So what was your kind of biggest takeaways and what should people really have taken away from this past week?
The biggest takeaway is that the soft landing scenario is alive and well, and that's what I see as the main cause of the curve steepening. So we've had NFP, which I think turned out a bigger event from a market perspective than the Fitch downgrade. So we've had a NFP which showed employment below 200,000, but it also showed for the second month in a row that wage growth was higher than expected, 0.4%. And I think what's happened is that we've moved into a sort of a new phase of the labor market where basically everybody who'd been losing their job because of the pandemic is now back at work. And so employment growth is slower, and it's basically constrained by availability of labor. But the pressure in the labor market, so the difference between labor and supply, if you will, uh, has not changed. If anything, it's getting tighter. There was a small decline in the rate of unemployment, even in the rate of underemployment, which is a broader measure. And so we're seeing an acceleration in wages. And the thing about wages, they were always going to lag prices because wages, as we both know, get adjusted less often than prices. So there was always going to be a lag. So the market focused only on employment, ignored the acceleration in wages, and sees, the labor market as, I guess, Goldilocks is here to stay, the soft landing scenario, everything is fantastic. And so we got a big movement in the curve. That's how I'm reading it.
That's your reading. Yeah. Yeah, I know like early in the week we were discussing, I was asking questions about how big do you think the actions from the BOJ, I guess a week ago, can impact the long end. And then I guess we had the refinancing data come out, which is much higher than expected. As we and many others have been complaining that in a time of how strong growth is and inflation is, this probably should be a time that U.S. government is cutting spending, not increasing spending. Um, but for the first time in a while, we saw like a real kind of, I guess, bear steepening kind of movement. But interesting that the market took exactly what you said, which is, yeah, growth a little bit slower, but the momentum in lower wages looks to be stopped or even reversing slightly. And surprised that the bond market took that as an okay sign, and concentrated more on, I guess, the slowing payrolls. Um, and then just in the actions, the data and everything, and any speeches from this past week. Have you changed your view about the Fed for the next couple of months and even say the next year or no?
Not really. So I continue to think that they will do another hike in November. And then what happens next depends on oil prices. If we have if oil prices continue to go the way they are now, I think come the fourth quarter, the Fed has a big problem on its hand because we will see an acceleration, a recovery in core inflation, and wages as well. So that will not be pretty. If, on the other hand, this oil rally ends like the previous ones this year, I think it will be more of a case of a sticky inflation. So the Fed will do its November hike, and then we'll wait for inflation to slow. And after a quarter or so, in my view, they are likely to be disappointed. And then they will start hiking again. So that's how I'm looking at 2024. Either we have an oil shock, and in that case, the Fed has to take the really hard decision. And I think that's when we get close to my Taylor rule estimate. Or we don't, anything is possible, or we don't. And then it's a case of inflation stickiness, which I think means the Fed will have to start hiking again. Obviously, with much less urgency than in the case of an oil shock.
Right. And I guess oil is not just oil, but gasoline prices. Obviously, they're correlated, but particularly gasoline prices have been heading higher. And for those people who are interested, particularly on going deeper in energy, Varesh wrote a really interesting piece about, which is probably not great into your questions or your narrative about the production in the U.S. seems to be peaking. So that definitely is another concern. And then, okay, so for the week ahead, what are your kind of big views, big takeaways, big concerns?
The CPI. So the CPI. So you know that Sam, whose last name shall not be pronounced, has come up with a great model for predicting the CPI, where he's speaking, basically, is giving bigger weights to forecasters with better track record. And he's actually outperforming models such as the Atlanta Fed, for instance. So he's predicting a CPI increase of 0.3% core month on month against 0.2%. And to me, it's much more consistent with the trends we are seeing. Wages perking up, also the flat core services without housing, I think, was noise rather than a signal. So the zero number we got last month. So this gives me confidence that all those macro trends that always take time to come through will start to come through this week. So that's my big call for the week. Other than
a good plug for some of the machine learning work we're doing, which Sam is involved in. So, I mean, it's one data point, but it's a good thing that people should be looking at CPI, and we'll be sharing more information about the kind of the methodology and our predictions and things like this.
Oh, sure. We have a lot of exciting new products in the pipeline. No question. So this is really the big event of the week. The other thing that will be interesting is the University of Michigan consumer confidence, not the headline number because it's so decoupled from the real data, but the long-term inflation expectations. Inflation has been above 2% since the middle of 2021. So more than 2 years now, and very, very, very slowly, but very steadily, we are seeing the long-term expectations in that survey creeping up. So, maybe we get another 10 basis points there. So that will be the really more interesting stuff. There will be a small business survey where I'll be looking at measures of labor demand, which I expect to remain strong, and also measures of access to credit, which I expect to continue to not be an issue. We'll get the PPI, and there I agree with the consensus that sees a small acceleration. We've had a very flat PPI for the past few months. And again, I think this is more noise than signal, because when you look at things like climate change, which I think is turning out to be like a negative productivity shock. So it raises costs for everybody. Or deglobalization, the fall in imports, in the basket of consumption goods, and so on and so forth. All this suggests PPI that, if anything, grows faster than before the pandemic rather than slower. So that makes sense. A couple of Fed speakers, Bostic, Bowman, Harker. Bostic was very interesting this week because he started to walk back the 100 basis points that the Fed has penciled in for next year, the 100 basis point cuts the Fed is planning next year. And it's interesting because Bostic is probably one of the most dovish committee members. So he started
the Fed had been thinking about, or the market was pricing it?
Both. The Fed SCP, the latest SCP, shows rate cuts of 100 basis points next year. And we had Bostic this week who said, well, maybe not until the second half of the year at the earliest. So coming from a dove, you have this walking back of the cuts, which makes me think the Fed realizes that inflation is going to be sticky. Yeah, that's the best case scenario, stickiness.
And you actually think that that's an interesting trade at these levels, which is to fade those 100 basis points plus cuts priced in?
100%. I mean, the Fed is dovish, which means they need a lot of evidence showing that inflation is not slowing or inflation is going up. But when they have this evidence, they cannot not act. So definitely.
Yep. And then I'm just reading a thing. So, and I understand this number is volatile, not always like a perfect predictor where GDP is. But the Atlanta Fed is saying the initial forecast for Q3 GDP is 3.9%. Is that right?
So which is enormous and is likely to come down. But still, I mean, GDP this quarter was nearly 2.5%, when trend is about 2%. And in terms of the labor market, if you look at the relationship between unemployment and wage growth, you cannot have a slowdown in wage growth without a rise in unemployment. And you cannot have a rise in unemployment, I mean a significant rise, when growth is going at or above long-term trends. Yeah. So, So Mr. Market or Mrs. Market, or whoever, they have high hopes, but I think it's a matter of waiting for those macro trends to show up in the data.
Right. Okay, cool. Anything else that clients, investors should be thinking about? Yeah.
No.
Jackson Hole, do you see anything like any big announcement coming there, or you want to think about it more?
So Jackson Hole, I've mentioned it to clients already. It's going to be about how global supply chains or global supply is not as elastic as it used to be. I'm not expecting a big policy speech. I think there is not enough conviction on the part of Powell to come and deliver a speech that would change policy one way or another. So
why sell optionality in this market?
It's so cheap.
Basically, yeah.
Yeah, agreed. I'm not sure this is a vocabulary he used, but that's basically what it is. So I think it will be more like an academic conference than a market moving policy event. Yeah.
Yep. Okay, cool. Awesome. As we always like to do towards the end, just highlight, especially for professional and wealth clients, some of our favorite pieces from the week. The Henry's PCA rates model piece has flagged a whole bunch of very interesting curve trades. He's continuing to tweak the model, and the performance of those trades have been think it's like north of 70% hit ratio, positive hit ratio, which is amazing. So a lot of
It
super
is.
interesting trades for that. And also everyone should be looking out that we're looking to expand that into emerging market yield curves, and also even much shorter dated kind of G5, G10 currencies, interest rate curves as well. Obviously, the rates weekly, we added a few interesting trades there. Several working pretty well, particularly in the short 10-year treasuries versus JGBs. And another trade is, that we kind of briefly touched on, which another interesting piece was Varesh's piece talking about production in the U.S. Basically peaking, and obviously combine that with reinforcing from the Saudis extending their a million, I don't know if it's like 1.5 million now, but their 1 million cuts that they had recently announced, extending that. And then also, particularly over the last week, we added a lot of several different new interesting FX trades, and we also debate another trade that people have been thinking about. So across from sterling CAD to Aussie, Euro Swiss, those are all interesting things that people should definitely check out. And so far, the timing seems to be pretty good. So great job to all the researchers. That's it from my side. Just wanted to wish everyone good luck, and I hope everyone's enjoying the summer. Fairly quiet markets, but it feels like volatility picked up a bit this past week. Let's see if it continues. And good luck to you. Everyone enjoy the weekend, and Dominique, you enjoy the weekend as well.
I will. Take care, Andrew.
Cool. Thanks. Bye.